I want to talk to you about what companies should focus on to improve their earnings. I read an article that you wrote, I think, in 1977. The world has changed since then, so I want to get a sense of whether you still believe that the 5 things that you had then spoken about in terms of improving earnings stand true today. You said then that companies should be doing one of 5 things: hiking turnover, cheaper leverage, more leverage, lower income taxes, wider operating margins on sales. What would you now say to companies who are looking at bettering their return on equity?
Well, I do look at those qualities in terms of businesses, and when I look at something like a Coca-Cola, which has been around since 1886, I say to myself, they are now selling 1.6 billion 8-ounce servings of Coca-Cola products every day throughout the world. Everybody in this room has something in their mind about Coca-Cola, and I hope it's good, incidentally. And certainly, what are the chances that Coca-Cola will be selling more products 5 years from now or 10 years from now than presently? I would say it's almost a certainty. I mean, there will be more people. They will have more purchasing power. This product is a huge bargain. This product sells, if you buy it on weekend specials like I do, this product sells at about twice the price that it sold at 100 years ago. There aren't many products like that. So it represents, the cost of this represents for the average person maybe a minute or two of their earning power, and it provides a moment of refreshment and happy memories, all kinds of things. So will they be selling more Coca-Cola a few years from now than they are now? Almost certainly. They're Coca-Cola products. Able to price their product so as to counteract the effects of inflation and so on, sure. So it's a pretty simple type of evaluation. I can't look at some new idea. People send me these big envelopes, filled with 200 pages of diagrams about some new product or process. I don't have the faintest idea what's going on in those things. But I can understand this. I can understand chewing gum. I've got a pretty big mind here. I got my mind around chewing gum years ago. And I stick with products where I think I can really see what's likely to happen over 5 or 10 or 20 years. And then those variables that we talk about in terms of return on equity enter into my calculations. But the important thing is to be in the right business and with the right people. And if you're in the right business, you don't go crazy in terms of what you pay for it. It's just like my buying that farm. I didn't go crazy in terms of what I paid for the farm. I had an honest guy running it. It happened to be my son. And, now corn is selling, for well over twice the price it was in the mid-'80s. Soybeans are selling at 3 times the price. So the farm is worth more money than before. And over the years, it's just kept delivering a check to me every year. That's what investment is about. And it's really looking at the future income potential of a business and comparing it to what you have to lay out now to get that income potential. And that's investment. And I think that when you get into buying something where you're just betting on whether people will pay a little more for it next year, when it doesn't produce anything, there's nothing illegal about it. It's not illegal, it's not immoral, and it probably isn't financially fattening either. But you're betting on really investor attitudes or speculators' attitudes rather than betting on the asset itself.
So what attracts you to that can of Coke? Is it the taste or the fact that you've bought a major share into the company?
I didn't quite hear.
What attracts you to Coke? Is it the taste or the fact that you bought a major share?
Yeah, well, no, I don't want you to think of me as someone who would be up here drinking Coca-Cola because I had a financial interest in it. I mean, who would do that? Be sure you get this. We get the profits. We own about almost 9% of the company, so we get the profits on 1 out of every 11 cans. So if you have any of this out there, just open the can. I don't care whether you drink it or pour it on your neighbor. But just be sure you open the can. I'll make a confession here. You'd nail me on it anyway if I misled you. I drank Pepsi for a long time. And the reason I drank Pepsi was that when I was a kid, Pepsi came in a 12-ounce bottle for a nickel, and Coke came in a 6.5-ounce bottle for a nickel. And you probably have gained enough insight into my personality by this point that you would understand why I chose Pepsi. And then Pepsi for a long time, it's a very interesting story because it's very hard to change the personality of a product in the consumer field. I mean, it's very dangerous to be, selling a product with one promise made through advertising and so on, and then shift gears. Pepsi did that successfully. Pepsi always was twice as much for a nickel too, was their slogan. In the 1930s, the number one jingle was Pepsi-Cola hits the spot, 12 full ounces, that's a lot, twice as much for a nickel too. Pepsi-Cola is the drink for you. Well, it was delivered somewhat more professionally than that. But it was sold on the basis that you were getting twice as much for a nickel. And then and that worked for a long time. It gave Pepsi a position, but it positioned it as a price product. And then they made the shift successfully, which was remarkable. Sometime after World War II, they decided instead of selling the cheaper product, they would do Pepsi for those who think young and all these different other ideas. And they successfully replaced, in the public's mind, a product that was offered based on price with one that was offered based on some other quality. And it was a remarkable marketing achievement, one of the great ones of all time. So when they went to where they were charging the same price as Coke, I had to go for the real thing at that point.
There you go.